So welcome back after completing your activity, and we're going to start looking at forecasting and planning. So these financial departments will use all the collected information to present a full financial picture and plan budgets as part of their planning function. The budgets are usually developed using a series of financial projections that the organisation believes will be what it needs to operate at full capacity. So they can have a number of budgets made from those projections: cash budgets, capital budgets, operating budgets, and these will be used to sort of maximise profits, make best use of monies and resources, and I suppose to identify where additional funding or resources are needed. So the financial department is going to be responsible for making forecasts, and they will use information such as projected income statements, cash budgets, projected balance sheets, projected use of funds, and additional funding sources. They'll bring all that together to try and make an accurate forecast, and it's important because it provides executives with the financial picture of what is expected in coming years, and they'll use that to determine their budgets, how they'll allocate funds, and how they'll agree to save or the need to borrow funds for certain projects. But forecasting income and expenditure is not intended to give an exact figure, but there are some methods that can be used to try and make it as accurate as possible, and some key things to consider. First is to make sure that you research thoroughly. It's about gathering data on the past, present and future. You should know about normal expenses, outgoings, reoccurring payments, and you can look at how they've increased and estimate that, or how other businesses, the sector has developed, and consider or expected changes. Think about analysing trends and other things that in the past have impacted on revenue. You can use data from previous financial reporting, industry case studies, sector reports, predictions, and any other relevant data sources. And secondly, you need a thorough breakdown of the expenses. It needs to be detailed, a detailed account of the yearly expenses, which is why all that financial reporting we talked about is so critical. It needs to ensure it's considered all the regular costs and estimated any additional or occasional expenses, preferably estimating the irregular ones up, as it's better to plan for a higher cost and then to have a budget surplus rather than the opposite. And then thirdly, it's about the organisation's cash flow history. Predicting future growth phases is difficult, but performance over the last few years should give you a good guide. If the organisation has big changes or developments planned in the strategy, such as a new product line, diversity into new markets, expansion or collaboration and partnership, for instance, it will need to be considered, and you could research similar projects or similar events to try and estimate the revenue flows and to know the direction the organisation is moving or might be heading. And although accurate forecasting is important, it is not easy. The people doing it face a number of challenges, and we've identified some when we talked about things to consider, but the main challenges to forecasting are the factors from outside of the organisation's control. The external factors are the ones that are hard to predict. And the first is customer sentiment. Economies fluctuate and customers' emotions and feelings have a massive impact. How confident do people feel about the situation? Will it stop them purchasing houses, cars, electronics? Will it stop them travelling? Are they being swayed by news stories, rumours, environmental factors? We can't predict these things, but we do get hints from the news and from experts' views, and organisations need to consider these indicators of possible negative positive sort of impacts on retail sales, for example. And then there's the impact of disposable income, tracking the rise and fall of the amount of money customers have to spend, what's remaining after their bills, allows organisations to sort of determine how much they might be able to sell. And this, combined with the customer sentiment, can be used to anticipate whether customers have spare money, so therefore can your organisation predict getting some of that money as part of its sales. And then there's things such as residential property markets, what the price is like. It all impacts on things. The cost of fuel all have a big impact on the costs to business and the costs to consumer. There's then how many people are employed and what the level of wages are, and the typical British one, the weather, currency fluctuations, if products are priced in dollars or in euros. Raw material costs, again, the cost of those going up can have a serious impact on your predictions, how your production figures are, and if there's any sort of impact on delays or things that have happened, and then finally any changes in laws or government policy which could impact on your forecasts. All these things need to be considered as part of the process of considering and making sure these figures are as accurate as possible. So we need to consider all those things as we develop our forecasts, and we can use a number of methods or approaches to develop those financial forecasts. Some of them quantitative, some of them qualitative, as we talked about in Project Management 508. The quantitative approaches rely on the quantifiable data which can be statistically manipulated, and their methods such as: the first is causal, where we assume that an item being forecasted has a cause and effect relationship with one or more other variables. For example, if there is a cinema nearby a restaurant, we might imply that because when there's people going to the pictures, that increases sales, and after it's finished, it increases sales in the restaurant. So if we were opening a new cinema, we may, by causal effect, presume that it would increase sales in nearby restaurants. The next is time series, where you derive forecasts based on historical patterns in data that are observed over an equally spaced time interval, so it might be yearly. The assumption is that the reoccurring pattern in the data will repeat in the future. 3 examples of methods are rule of thumb, which is based on a simplified analysis of just copying the data forward without changing it. So if it happened that year, it's going to happen that year. Decomposition, where analysis breaks it down into trends and seasons and variations and cyclic components to forecast each different situation. And then smoothing, which is the opposite in some respects, because it's about taking the averages of past results, possibly with some weightings or thinking about recent data and increases, but smoothing out the irregularities and just giving us an average increase, say, of yearly sales. And then there are the qualitative approaches that rely on information that cannot actually be measured. So examples of these sort of methods could include things like market research, so based on discussions or focus groups from current or potential customers regarding your goods and services and what they think of them, feedback basically. Internal and external expert opinions, so knowledgeable people giving their opinions using their in-depth knowledge to see what they think the forecast might be like. And then finally, the Delphi method, as we discussed as one of the project management methods 508, a structured methodology deriving forecasts from a group of experts and then a facilitator using multiple iterations to get them to revise their thoughts. So they're the sorts of approaches that you could use for the qualitative methods. And whatever method has been chosen to do forecasting, we need to, just as we do with other things, think about recognizing what has worked and what doesn't work and sharing that. We need to think about specific situations and how improving or developing it is key. Example, we may have used, experts, but found out that they all just agreed with each other and didn't really consider all the possibilities. So next time we decide to use the Delphi method, or all were internal and we need a wider perspective, so some of our experts need to be external. Whatever we use or change, this needs to be captured and shared, and we need to develop good practices, and this might be about including in policy for financial governance, stating how forecasting will take place, or we might see changes in responsibilities, something in the finance department might have changed, and we may need to think about sharing that and reflecting on it and evaluating it and storing it with that forecasted data, as we talked about in project management, so that it can be used at a later date. But as we said, forecasting is not a science, and things may happen that impact on budgets. We might talk about things that need to change. We listed there all the problems there can be with forecasting. So other internal things may impact on budgets as well. An organisation should have a policy and a process that are in their financial governance, and there should be some procedures in place for budget revisions. This might be to trim excess spending, reallocate revenues, or to make allowance for unexpected or uncommon expenses, or as we've talked about, inaccurate forecasting. Reasons for budget revisions might also be things like short-term projects or projects for new products or ideas. They may need to be continually revised until the budget is and the figures and production costs can actually be worked out or substantiated because it's totally new. Or on a short-term project, it may be so short that it has to be completely reviewed as you're going through and made changes as you're going through the process. There could be one-off events, so we need to make allowances for one-time events that may significantly affect plans. So we may need to look at rejigging the budget because we might have had excessive spending, or there may be duplications of processes as things changed. And then there's ongoing evaluation and review, so it might just be generally that if we're doing good financial management, that we've evaluated it and then we've realised that it needs to be updated on an ongoing process, or we may have to revise cash flow statements or income statements. Too little is coming in or too much is going out, and we may need to trim the fat and look at changing the budget there. Wherever it is, there'll need to be a process in place where budget revisions can be put forward, and there is a process to get them agreed. Okay then, we're coming to the end of this session, and just before we do an activity, chance to quickly recap and make sure we've covered everything. So our aims were to understand the importance of financial management, and we assess the importance of financial practices. We explain the governance and compliance and the different areas, and then we had a second aim to understand methods of financial forecasting. And we've explained the importance of accurate forecasting, we've described the challenges that could be there, and we've evaluated some methods of financial forecasting at the end there. So let's have a look at the activity. So it's a two-part activity. There's a worksheet for you to download, literally given a description. But for part one, you need to think about describing the characteristics of financial forecasting and explain why accuracy is important. We've talked about that, including that description, the sort of principal features of two challenges faced in creating accurate forecasts. And then for part two, you need to evaluate two methods of financial forecasting and draw some conclusions as to their merits and usefulness for estimating financial outcomes. Now, that might be better if you think about your organization or your sector, your situation, and use that as a context, because it'll be easier to evaluate them in a context. So do that and upload it, and then you can start on session 2.